Welcome to TalkTickers. Today we're diving into Continental AG's first quarter 2025 earnings call. They're, a huge player in automotive tires and also that Conti Tech business.
That's right.
So we'll unpack the numbers, see what management's saying about the road ahead, and figure out the key takeaways for you.
Absolutely. And Continental definitely kicked off 2025 showing some, let's say, positive signs. Profitability improved overall.
Okay.
Yeah. Their adjusted EBIT margins saw a pretty noticeable jump compared to last year.
Good start then.
Definitely. And the automotive side, that really bounced back strongly from what was, frankly, a weaker prior year.
And tires?
Tires showed healthy organic growth. That was mostly driven by their price mix, how they're positioning their products.
Right.
Conti Tech, now that was a bit different. Sales actually dipped there. But interestingly, they held their margins steady through some tight cost control.
Okay, holding the line there. What about cash flow? Always a big one first quarter.
Yeah, free cash flow looked a lot better than last year.
Right.
Still negative, mind you, but that's pretty typical Q1 seasonality for them.
Right. Expected.
Exactly. And finally, net debt that came down significantly year over year. So some good housekeeping there too.
Okay, let's really unpack automotive then. You mentioned that adjusted EBIT margin improvement was substantial. What's the story behind that number?
Well, it really seems to be the payoff from actions they've already taken. Those self-help measures they've been talking about, plus the pricing strategies they put in place earlier. That's really driving it.
Sustainable pricing, they called it.
Exactly. And apparently March sales actually came in better than they expected internally. So it suggests these aren't just temporary blips.
Okay, sounds promising. But they did sort of temper expectations, didn't they? Saying future comparisons will be tougher. Why is that?
Yeah, that's a really important point. While Q1 was strong, you have to remember that things actually got progressively better last year, quarter by quarter, because of those same pricing actions kicking in.
Okay. So the bar gets higher.
Precisely. The benchmark they're up against just gets tougher as 2025 goes on. The slight positive is that the usual Q1 seasonality seems a bit less harsh this year.
Right. Makes sense. Now, architecture and network solutions. Sales dipped slightly there. What's the thinking? A deliberate move.
Seems like it. It looks like part of their bigger strategy to focus on value creation. They're prioritizing projects that promise better profits.
Okay.
Which, might mean walking away from or even closing less profitable business. Right. So that slight dip seems strategic, yeah.
And part of that value creation often involves efficiency. They mentioned headcount reductions.
They did. And you can see the impact pretty clearly in their adjusted R&D spending. It was noticeably lower than Q1 last year.
So those cuts, starting back in early 2024, are feeding through to the bottom line.
Directly contributing to a leaner cost structure, yeah.
And interesting that automotive seemed to outperform the wider market, especially in Europe.
That's right. Europe was a particular bright spot for their automotive division. They grew faster than the overall market there.
So gaining share or just in the right spots?
Could be a bit of both. Either gaining share or maybe just better positioned in the stronger parts of the European market right now.
Looking ahead then, order intake was way up. What does that signal for automotive's future?
Oh, absolutely. Orders were significantly higher than Q1 last year. Big contract win for radar systems in North America too.
Radar. Okay.
And what's really telling is how much of those new orders came from autonomous mobility. That's clearly a huge focus area, and they seem to be gaining traction.
So betting big on self-driving tech and margins for the rest of the year in automotive, what's the expectation?
They're guiding for consistent improvement throughout the year, pretty much across the board in automotive.
Okay.
Safety and motion was called out as having particularly strong momentum. They promised more details at the Capital Markets Day in June.
Right, that's coming up.
And importantly, they did confirm they expect Q2's adjusted EBIT margin to beat Q2 of last year.
Okay, good signal there. Let's switch gears then. Tires. Solid organic growth, you said. What drove that price mix again?
Primarily price mix, yeah. They're selling a richer mix, basically, getting better prices for the tires they are selling. Volumes were up, but only modestly.
So pricing power is key.
Definitely. And demand in the replacement market, that was healthy everywhere. Cars, trucks, all regions. Original equipment, though, still pretty sluggish.
And that price mix, was it enough to overcome other pressures? Like raw materials?
It was. That positive mix, which comes from, good sales execution and people still wanting those premium ultra high performance tires, that more than covered the headwinds from higher raw material costs.
Were there any other sort of external drags on the tire business?
Well, foreign exchange rates actually hurt them a little bit this quarter. Last year, same time, FX was actually a positive contributor, so a bit of a reversal there.
Okay. Now, strategically, they're focusing on commercial specialty tires and getting out of agricultural tires. What's the play there?
Yeah, that's a clear strategic shift.
Right.
They're doubling down on areas like material handling, earth moving, port operations, those kinds of specialty commercial tires.
Right.
And winding down the ag tire business by the end of 2025. It's about focusing resources where they see better returns or maybe stronger growth.
And the plant closure in Malaysia, is that part of the same strategy?
It fits right in. It's part of optimizing their whole manufacturing network for tires, trying to get more efficient, boost returns by consolidating production.
Makes sense. So looking ahead for tires, Q2 specifically.
They expect that positive price mix to basically hold steady from Q1 into Q2.
Okay.
Raw material costs, though. Still expect pressure there, probably similar to Q1 levels, but maybe leveling out later in the year, they're hoping.
And volumes.
The aim for the full year is positive volume growth. And they stress that, especially in the U.S., pricing decisions will be guided by value creation. Got it. Okay, let's turn to Conti Tech. Sales down, but margin held. How'd they pull that off?
Yeah, it's pretty impressive, really. Holding margins flat despite lower sales, that points to really strict cost control.
Discipline.
Exactly. And optimizing price mix where they could. But yeah, backdrop is still tough, weak auto and industrial markets hitting their top line.
What's the outlook for Conti Tech going forward? Improvement coming?
They're forecasting things to get better in the industrial side of the business, but mainly in the second half of the year.
Okay.
But they were pretty cautious, acknowledging, global economic uncertainty, trade barriers.
Right.
It makes the strength of that recovery hard to predict.
So still managing costs closely.
Oh, yeah. Ongoing efforts there, optimizing the cost structure, their footprint, all through 2025.
And near term, Q2 for Conti Tech.
Expecting sales pretty similar to Q1 levels. That recovery is definitely weighted towards the back half of the year. That's based on market research, customer feedback in areas like construction, mining, energy.
But some areas still shaky. Right. The off-highway sector they specifically called out as volatile. Timing of any recovery there is pretty unclear.
Okay. Now the big one, the spinoff. Omoyo is now Omoyo. How's that progressing?
Still on track for September, seems like. The plan is holding.
And the costs involved?
They gave some figures. Spin-off costs themselves in the low to mid three-digit million euro range, and tax is also looking like low three-digit millions.
Okay. And as you said, the automotive and contract manufacturing part will be called Omoyo.
Omoyo, yeah. Bit of a mouthful, maybe, but that's the name.
How does this split affect their guidance and reporting?
They've essentially split the guidance now. You've got continuing operations, that's Continental with tires and Conti Tech, and then discontinued operations. That's a future Omoyo business.
But the underlying targets haven't changed.
No, the fundamental triggers and goals for each sector remain the same. They just sit in different buckets now for reporting.
And the Capital Markets Day in June will shed more light.
Exactly. They'll dive deeper into the KPIs and drivers then. One day focus on Omoyo, the other on the continuing Conti businesses. No big reporting structure changes expected then, though.
Okay. Tariffs. Always a worry for global companies. How's Continental handling this?
They've got dedicated teams on it across all sectors, really actively trying to mitigate the impact.
How? What are they doing?
Well, focusing on increasing imports that comply with USMCA, the U.S.-Mexico-Canada agreement.
Right, NAFTA's successor.
Yeah, and looking at longer-term tweaks to supply chains, production locations, plus reviewing customer contracts to try and reduce their net exposure.
And given these tariff worries, what's their view on global car production now?
They've actually lowered their expectation for 2025. They now see worldwide light vehicle production declining, especially in North America. So that's pulled down their overall outlook a bit.
But the current guidance doesn't bake in any massive new tariffs.
Correct. They're saying this situation is just too volatile, too dynamic right now to factor in potential major shifts in global tariffs into the official 2025 guidance.
Can you break down how potential U.S. tariffs might hit different parts of their business?
Sure. For automotive imports into the U.S., actually most already come from Mexico, so they're USMCA compliant. That helps.
Okay.
Tires are different. Most U.S. tire imports are from Europe. Though it's worth noting, a lot of the tires they sell in the U.S. are actually made in the U.S.
Ah, a local production buffer.
Exactly. Their action plan for tires is basically max out existing North American capacity, look for ways to squeeze out more efficiency. But big capacity jumps would take time and money.
And the overall market impact of tire tariffs.
Yeah. They basically said it's too early to tell definitively. They expect things to move fast. Market dynamics could shift quickly.
Okay, makes sense. Any other key announcements from the call? Leadership changes, other updates?
Yeah, a couple of things. New board members coming in, a chief human resources officer starting in July, and a new CFO taking over in October after a handover, both coming from within the tire business, interestingly.
Internal promotions, then?
Seems like it. Also, those restructuring costs, $180 million booked in Q1. That's ongoing. More R&D workforce cuts planned for 2025-26. And their big SG&A cost-cutting program, Accelerate, is apparently on track.
Anything on asset sales or disputes?
The sale process for their OSL business, that's moved to the M&A stage now. And the BMW brake issue, no real news. Vehicles are being delivered. Relationship is constructive, seems like. Status quo.
Right. Okay, let's move to our final segment. This is not financial advice. Time for some outrageous but plausible trade ideas based on all this. What have you got?
Okay, idea number one. Given Continental is deliberately exiting the agricultural tire business by late 2025.
Yeah.
And focusing elsewhere, maybe, just maybe, consider looking at a competitor who is heavily specialized in agricultural tires.
Okay, the rationale being?
As Conti pulls out, a specialized player could potentially pick up market share, maybe even get some pricing power if competition eases. It's speculative, of course.
Highly speculative.
Absolutely. Depends totally on that competitor's own health, market position, ability to execute. Needs serious homework.
Got it. Outrageous idea number one. What's number two?
This one involves the spin-off, Omoyo, and that strong order book in autonomous mobility.
Okay.
How about a paired trade? Go long on maybe a select supplier that's really reliant on Omoyo's autonomous driving unit, betting that specific segment grows well post-spin-off.
And the other side of the pair?
Short a broad automotive supplier ETF, just to hedge against general sector ups and downs or volatility.
Interesting. So betting on a specific niche within the spinoff hedged against the broader sector.
Exactly. But again, big risks. Depends entirely on how well the spinoff goes and whether that specific supplier you pick actually delivers. Lots of ifs.
Definitely outrageous but plausible territory. Okay, so wrapping things up, Continental showed some real resilience here, didn't they? Improved profits, better cash flow despite the choppy market.
Yeah, they're navigating a lot. Strategic shifts, the big spinoff coming, global trade headwinds. But Q1 showed some underlying strength, especially from those earlier efficiency and pricing moves.
The Omoyo spinoff is obviously the huge event to watch. It promises, more focused strategies for both the new company and the remaining Continental.
Absolutely. Two potentially leaner, more focused businesses. And tariffs remain the big question mark, that key uncertainty. How well they manage that mitigation plan will be crucial.
So plenty to keep an eye on. We definitely encourage you, the listener, to dig into Continental's own materials if this is relevant to your interests. See how these insights fit your own view.
And remember, nothing we've discussed here is financial advice, just exploring the dynamics.
Stay curious. Keep digging into what's shaping the auto and industrial world.